We're nearing the end of another hot summer with its usual challenges of high electricity demand and frequent conservation warnings across the United States. But this year, seasonal demand fluctuations aren't the only challenge. Power demand, for the first time in nearly 20 years, is on an upward trend completely unrelated to weather impacts and other factors we've become accustomed to handling. You're listening to Energy Rush, a special podcast series from the Electric Power Supply Association, where we will look at how the grid is responding to load growth across the system. We've gathered over 15 different expert voices from across industry, policy, and the regulatory landscape to get to the root of what's going on. You will hear from a range of viewpoints on the challenges posed by rising power demand and the solutions and opportunities that exist for all involved. In this series, you'll hear the highlights of these vital conversations, and you'll hear how leaders across industry are both keenly aware of this hot button issue and how they're working to meet the moment. I'm your host, Todd Snitchler, President and CEO of the Electric Power Supply Association. The Electric Power Research Institute has estimated that a Google search performed using ChatGPT uses as much as 10 times more power than a traditional search. And ChatGPT's energy usage per day equals 17,000 times more than that of an average household per day. With electric vehicles and chip manufacturing having been on the rise for some time, AI and data centers present another challenge to an already strained power system. In this episode, you'll hear from Jennifer Hiller, a reporter at the Wall Street Journal, Karen Onaran, President and CEO at the Electricity Consumers Resource Council, or ELCON, and Anthony Crowdell, Managing Director at Mizuho Energy Group. Jennifer, Karen, and Anthony help us chart the landscape and share with us what's been driving this demand growth and why, while the exact numbers remain to be seen, it's not going anywhere but up. Jennifer Hiller is a reporter at the Wall Street Journal who covers many aspects of the energy space, including renewables development, electric vehicles, and the energy transition, or as we prefer to call it, the energy expansion. She tells us all about the load growth data she's seeing state by state, when she started to see this as a challenge, and what exactly is causing this rapid load growth. Let's hear from Jennifer. Jennifer, thanks so much for taking a minute to chat with us today. As you know, we're talking about load growth. It seems like every time we open the newspaper or any one of the news reporting services, we're seeing stories about it. As an energy reporter, you're probably closer to it than most. So what are you seeing in your work about load growth and how it's impacting the entire industry?
Well, I definitely think load growth is the conversation of the moment right now in electricity. And it's just fascinating. And it's happening, but it's uneven, I'd say. It's not happening everywhere, but there are a handful of states with a lot of economic activity and a lot of electric load growth going on. And there was a recent EIA report that came out that looked, I think, at commercial demand for electricity. And it was pointing out that there are states that have had some rapid data center development, especially Virginia and Texas, and, places like Arizona and Oregon that are seeing, these sort of big increases in demand.
So let me take one step back. When did you start to see this start to emerge and then really pick up the pace where this is kind of the topic that everyone is interested in?
Well, I'm sure that I picked up on it well after it was already happening, but I started to look at this last fall. I was working on a story about Texas load growth and had just been looking at the really high spikes in electricity use last summer because there was an exceptionally unpleasant and hot summer in Texas and a lot of other states. And just to try to broaden the story, I started to look around at other states and I was looking at electricity sales just to see if anybody, like what other states had also seen, already this trend of rising electricity sales. And it was just, frankly, this weird bunch of states that at first glance did not make a lot of sense to me. They didn't seem to have a ton in common. It was like Texas, Oregon, Virginia, North Dakota, Iowa, just this kind of weird mishmash. But one thing that they do have in common is that there's a lot of data centers, or some of them have attracted Bitcoin mining. They're also seeing a lot of manufacturing growth.
It seems like everyone's got a different projection about both the volume or the amount of power that's going to be needed and how quickly we're going to need to get those megawatts on the system. What's your reporting and your research telling you about how you view that? Is it the crisis that some have? I know that that's helpful to get people to click on the article, but is that what your data is telling you and what your reporting is suggesting, or do you have a maybe a different perspective? There's a different trend line that you're seeing.
I think there's so much divergence in opinion on
Okay.
what is going on with data centers and how much power they're going to need. I like to look at the EPRI estimate,
Yeah.
the Electric Power Research Institute. Their estimate is something around 4% of power consumed last year in the US was for data centers, and that it will be something between like 4.6 and 9% by 2030.
Okay.
There's like a wide divergence of, that this isn't going to be a big deal and it's not that much power to it's going to kind of eat the grid
Yeah.
and it needs unending power. And it really can't be either one of those things. It
Right.
seems
It's
like it's going to need more power.
right. But it's the proverbial, the truth probably lies somewhere in the middle, right? I mean, as I look at it, we've seen the range of projections, and I know it's not zero, and I'm fairly certain it's not 10% year over year, but I don't know exactly where it lands in the middle. And that's, of course, I think what everybody's trying to get their head around is what will that number actually be?
Yeah, and I think it's really hard too to try to figure out just what's going on within the tech industry. And, within that industry, people are arguing about whether or not there's, some kind of AI bubble
Right.
going on. And, that is an industry that can go through ups and downs. It's also an industry that can, has become more and more efficient over time. And so you
Mhm.
could see some efficiency leaps happen kind of on the computing side of things. And so it's just really hard to pinpoint.
Right. Exactly. Like, what's the target? We're aiming at a number that seems to be moving in real time.
Exactly.
Yeah. You've written in particular about the needs of AI and data centers and some of the challenges that they present to the grid. And we've talked a little bit about that. Are there any key, like top three takeaways that you have based on your reporting that maybe people who are listening ought to be keeping in mind?
Yeah, I think we're seeing a lot of different kinds of electricity demand growth. I think the
Hmm.
particular issue with data centers and some of the challenges there is just the kind of customer that they are. And that if you have a lot of them in one place, I think that can become complicated for utilities and for grid operators a little bit. They're always on. They need this 24/7, highly reliable power. Their critical infrastructure, as well. So they can't really power down. They're doing things that are like AI training and stuff like that. They're also kind of the backbone of banking transactions
Yeah.
and Zoom meetings and all kinds of things that we are heavily reliant on and have become more heavily reliant on since the pandemic. But they need this sort of always on power. They
Hmm.
have backup power on site, but they can't really use it to participate in demand response programs. So they're just this really inflexible load. And so I think what the data centers are doing is driving that peak load higher. And if
Yeah.
you drive that peak load higher, then you're going to have to probably add some more generation.
Yeah.
And then I think there's also some issues, for utilities and grid operators about, a user that is like a large user of electricity that's either on or off. And
Hmm.
if they don't know if they don't know what to expect, these facilities are becoming so large that you can't, you don't really want to get into a situation, I think, where there's like a gigawatt coming on and off
Right.
unexpectedly.
Yeah.
So I think there's probably a lot of, smart people who are planning on
Sure.
who know way more than I do about how you manage that.
Right. It's one of those things about the laws of physics always win. I think this is one of those situations that will remain very true. So
Absolutely.
the tech companies and the owners of a lot of the data centers and AI have talked a lot about reducing emissions. In your reporting, how are they thinking about approaching that issue based on the need for the amount of power that they need? Because as you just said, a gigawatt of power is not outside the question for what a hyperscaler or a data farm might need. How are they balancing those things based on the conversations you're having?
I think this is getting harder and harder for the tech companies. And I think that's showing up now in some of their carbon reporting because there's sort of a mismatch here that
Mhm.
they are, traditionally they have been big, big backers of adding more renewable power to the grid. And they've been incredibly active in that market for
Yep.
more than a decade at this point. You just can't build new generation fast enough to keep up with, I guess, the amount of new data centers that they need, and then how quickly you can build a data center. It's just faster to build a data center than you can build new generation. And then I think when you start to get deeper and deeper into kind of the climate math here and start to look at, well, if you're adding, a new user that needs 24/7 power, renewables really cannot meet that
Right.
without, a very unrealistic amount of batteries added. And so you get into kind of the messiness of
Hmm.
that you're using more fossil fuel power, and so that's, I think, one of the things that they're grappling with is, what kind of power are they actually using in these different facilities across the country or globally? And then I guess sort of how do you try to incentivize building, new clean generation?
Right.
And as you know, these are really hard things to do. There's not, it's hard to add hydro.
Right.
It's hard to add nuclear.
Yeah.
And, there are some efforts to try to get some more geothermal projects built and that sort of thing. But yeah, these are all, kind of hard, slow, difficult things to do.
Yeah. So, based on the conversations you're having and your reporting, what does this mean for the types of resources that you think we're both going to need and will be delivered? And what does that future energy mix look like? I mean, these are major demand centers, but they've also got expectations. How do you see that trend line evolving, call it over the next 15 to 20 years?
I think it's possible that we're going to end up with more of everything. I think we will continue to see a lot of new renewable energy added. We're seeing lots of battery storage being done, across the country, and especially in particular markets.
Mm-hmm.
We are also going to see some new gas plants. Just by necessity, if you're going to be raising that peak load and you need 24/7, you're going to be building new gas in the short term. And that's really hard to get around. I think you're going to have a harder time retiring older plants.
Mm-hmm.
I think that's going to, that's already an issue in a lot of places.
Yeah.
And, that it's going to become more difficult to sort of say goodbye to some of those older resources. And I guess if we're talking about over the next 15-year time period or so, I think you will start to see, things like geothermal or long duration energy,
Mm-hmm.
long duration storage come into play.
Yep.
There's a lot of efforts right now going on around the nuclear space and whether or not they can get some SMRs or other projects funded and financed and in the works. So I think we'll kind of see, I don't know that there's any one resource that solves the issue. I
Yeah.
mean, we'll have some more transmission too. Everything has a hard time getting built though. So
Yeah,
I
that's
know
exactly right.
everybody seems to have like their favorite resource that's going to solve all the world's problems.
If only they could get it built and it's cost effective. So the way you described it, it sounds a lot like how we describe this energy expansion. People call it a transition, but I think, as you know, we're going to need more and probably more of everything in order to help us get from here to there. So as we talk about this, I mean, we really are talking about a lot of policies that are driving decisions, and the IRA, of course, immediately comes to mind because that was a largest piece of legislation that has helped drive a lot of policy choices. How are you thinking about that, or what's the overall state of play on some of those policy drivers, and how are they both contributing to supply and demand? I mean, of course, it wasn't just IRA. There was the CHIPS Act and the IRIJA. I get my alphabet soup correct, but there's been a lot of policies that have been driving that. How are you viewing that from your reporting on how this is not just data centers and AI, but there's all sorts of other things that are having impacts. How's that shaping what you're viewing in the energy space?
I think there are these sort of competing demands. And I think especially in some areas, you could start to see more sort of competition for
Mhm.
readily available electricity resources.
Sure.
And, I think from like a policy maker or regulator perspective, I'm kind of looking for areas where, you sort of may be running into a wall. We've got a
Mhm.
lot of economic growth across a lot of these different industries,
Right.
the tech industry, manufacturing. We've got a lot of existing industrial that is trying to electrify. We've got transportation trying to electrify. And it's really difficult to make all of these things happen at the same time. So I
Right.
think we could be running into some roadblocks or just some sort of competition for resources. I think that's already happening to a certain extent.
Mhm.
But it is a tough policy question because if you don't, you have to figure out, the policymakers are going to have to figure out kind of what to approve and
Right.
what, I guess, depending on the kind of market you're in as well. Private companies are going to be, are already making gambles on where they think the market is going and
Mhm.
what they think is realistic to supply. And, in a lot of states, they're going to have to decide what they want to invest in terms of resources. The risk is that you overbuild and spend a
Right.
lot of money and then the growth doesn't show up. And that makes that makes politicians and customers very unhappy. So I think that's a risk in some areas. You could see some overbuilding as well.
Yeah, I think that is pretty much spot on. And so, of course, from our perspective, it won't surprise you that we think that we're better able to wear that risk than the customer is in places where there's overbuilding. If we overbuild that last plant and we make the mistake, then we're the ones that go broke. We don't put that on the backs of customers to go forward. So you kind of jumped ahead to what was going to be my last question, but I'll ask you if there's anything else that you think policymakers or regulators should be keeping in mind as they're thinking about some of these subjects. I mean, I asked that and even with even more concern because of the Chevron decision in the Supreme Court, which is going to require Congress at the federal level, certainly, to be a little more thoughtful about how they're drafting legislation. But outside of just legislation, what are some other things that you think people need to be keeping in mind if we're going to solve this and get to the other side of this load growth reliably, affordably, and sustainably?
Yeah, I think this is such a complicated time for the grid because you have this changing resource mix and all of these new demands coming in. And, you've got a lot of potential economic growth that could be facing headwinds,
Yeah.
from the ability of the system to respond. And so you could end up in sort of a winners or losers situation where you've got maybe a lot of growth in some areas that can meet the need
Hmm.
and other areas that are missing the boat. I guess these are good problems to have. These are
Right.
risks
Right.
for companies and for regulators. And I think just one of the key things is like the customer getting, you don't really want the customer and the cost
That's
aspect to get lost in the shuffle because
exactly
all
right.
of this stuff is going to cost more money and who is going to pay for it, is going to be, of course, the customers of electricity in the end. And I think making sure that that's done in a fair way is really key.
Karen Onaran, President and CEO of the Electric Consumers Resource Council, is up next. ELCON is a trade association that represents large industrial and commercial electricity consumers. Karen shares ELCON members' priorities for the energy expansion, challenges posed by load growth, and opportunities that exist for positive outcomes. Here's Karen. Karen, thanks so much for taking a little time to visit with us today. For those who may be listening and don't know who ELCON is or what you do or who your member companies are, can you kind of walk folks through who your organization is and what your goals are?
So ELCON is short for the Electricity Consumers Resource Council. We are the National Trade Association for large industrial consumers of electricity. So these can run from your standard manufacturers those that are in processing, anywhere from oil and gas, chemicals, air, or then you're just standard, we make stuff. And so these are very energy intensive organizations and companies. And so we try to focus mostly on the federal side of the energy issues. Occasionally we'll get into state matters, but each state kind of has their own little mini ELCON. And so we're sort of the federal umbrella that keeps tabs on what's happening in Congress, FERC, NERC. So your basic big picture wholesale market issues, wholesale issues that do end up having an impact on states.
Great. You are definitely covering the waterfront. We can relate on that.
Yes.
So as you look at it, what are the priorities for your members when it comes specifically to energy?
We have two outstanding priorities that are reliability and affordability of electricity. So what I've learned since I've been at ELCON, and maybe some others are not aware of this, that for the manufacturing industry, energy is their biggest cost. So it's not staff, it's not machinery, it's their energy usage. And so it is very, very important to make sure that it's reliable, because if we do not have power or if we do not have quality power, we cannot operate, and therefore millions of dollars in revenue can be lost. And then, of course, the affordability side of that as well. As I mentioned, electricity, energy is the largest cost. And so we want to make sure that those are just and reasonable if we do FERC speak. But, what that really means is that it's sustainable rates that, do not overburden both the company and their customers.
Karen, when you look at your list of members, you have a broad spectrum of people who are ELCON members. What's driving the growth generally of industry, or what has caused some of the uptick in the industry? I mean, I assume the easy answer is reshoring, but I also suspect it's more than that.
Sure. And absolutely, the onshoring is a big part of that. ELCON in the last decade has actually seen members leave the organization because all of their processes and manufacturing is happening overseas. So there really is no need, for a American federal policy organization. So onshoring is huge, and we certainly welcome these industries back on U.S. shores. I would say that the other driver is that because a lot of ELCON members are in the energy sector themselves, whether it's producing oil and gas, they're looking at some of these other technologies. They're investing in hydrogen, looking at opportunities where other products could be available, especially in the energy space. So I think initially that those are the two biggest drivers of at least the manufacturing. And I'll just point out now that ELCON does not represent any data centers currently. So we have a little bit of a different set of issues than perhaps, some of the big data centers do.
Yeah, thanks for pointing that out, because that's kind of the assumption a lot of people have, is that's the only thing driving load growth these days is data centers. And it's part of it, but it's not all of it. So as you look at it, what does that mean for your members' energy consumption and energy needs? I mean, I've often heard that manufacturers and others that are internationally exposed and energy dependent have a different set of issues. And I don't know if you think about it that way, but what does energy growth mean for their consumption and their needs as well? Because you mentioned a minute ago about needing highly reliable, or the 5 nines power. It's got to be available at 99.999%, or they can't operate. How's that driving some of the decision making and thought around policy around energy for your members?
Yeah, absolutely. And you'll appreciate, I know that EPSA is very much about, competitive markets for energy. And that is extremely important for us as consumers as well, to have that competitive platform out there in the energy markets and how we can consume or procure our own energy. So that's one very important issue. I would say the other one is infrastructure. We're very, very concerned about having the adequate infrastructure, whether that be transmission or even, some generation infrastructure out there. It's going to be very, very necessary. And, it's going to be costly. And so how do we balance the need for additional transmission or other energy infrastructure with not gold plating and just creating enormous costs for consumers? So that's probably the biggest concern right now as we're growing.
How are your folks thinking about the energy trilemma, reliability, affordability, and sustainability? And how are you trying to balance the need for reliable, cost-effective power with state and federal policy, decarbonization goals, or, energy efficiency, all the pieces and parts that come with decarbonizing the economy?
So again, reliability and affordability are going to be the top two
I'm
pillars.
noticing a theme here. They seem to be at the top for virtually everyone.
That's probably true. Yes, that seems to be, what we need out of our energy system, whether you're a consumer or a developer or producer.
Exactly.
So I think that's always going to be our primary concern. But we absolutely do understand the transition in the industry, and our members have their own corporate sustainable goals, our
Right.
decarbonization goals. So they are not blind to that third leg of the energy trilemma. and they are pursuing some of these, potential solutions of lower carbon sources of energy in the future and are actually investing in that. So we want to make sure that it is a balance. And I think
Right.
that that's what ELCON's been out there, trying to communicate with regulators is we absolutely know that the energy industry is transitioning to lower carbon. We're absolutely supportive of that. But at the same time, our first two priorities of reliability and affordability cannot be jeopardized with respect to, reaching some of these goals in a way that's not balanced, that's either too accelerated or not well thought out. And so, we are players in that. We want the industry to continue to decarbonize. We're decarbonizing our energy procurement. We're decarbonizing our own operations. There's a
Right.
lot of electrification going on in industry, whereas before they might have been more carbon intensive production methods. And now we're looking at electrification to sort of clean up our own processes. So we're part of that. We just really need to make sure that it's done in a balanced, well-managed way.
Yeah, completely. How are you all seeing the challenges that exist? You mentioned electrification, and of course, there's the data center issue, and manufacturing, of course, is a key part of a lot of this, but that poses a lot of challenges. What's the approach you're taking to try and address making sure everyone's treated equally across the spectrum? It's kind of our cost causer discussion that we often have. And how are you facing those challenges? Are you advocating for specific positions? Are you engaged with discussions around these issues, or what's your thought about how we try to navigate through some what could be fairly choppy waters?
Yeah, absolutely. And I've, been on the speaking circuit and even, just recently appeared before Congress with this sort
Right.
of same messaging that there are a lot of different things all coming to a head at the same time. And that is scary and concerning because any one of these on their own is a challenge. Whether it's the variability of some resources being weather dependent, whether it's being the slow development of infrastructure, or whether it's mandates, and so there's a lot going on at the same time. And so our message continues to be, let's look at the whole picture instead of just this is our one goal and we need to get to that goal. It's an admirable goal, but we really need to do that in a balanced way. And so I continue to try to raise the alarm that in addition to growing load, and I've been in this industry maybe 20 years, and we really
Sure.
haven't heard that much about load growth. It's
Exactly.
always been flat, flat, flat. And then with energy efficiency, it was even starting to dip a little bit. And so with this load growth, alone would be a challenge, but then we have a challenge of different operating resources. We have an infrastructure challenge. We have an extreme weather challenge. So all of these are all coming together. And so that is why we need to be absolutely on top of getting this right and getting it balanced so that we're not, jeopardizing any customer class. Elcon is very, very sensitive that we do not negatively impact, your standard retail customer as a
Right.
large customer. And so, we want to make sure everybody is fairly treated and, not to call out the data center industry, but I mean, there are some unique challenges there where they will need a lot of infrastructure to and a lot of energy
Yeah.
to support their operations. And is that going to increase our costs? So that brings in the cost causer
Yeah.
beneficiary pays standard, which we always talk about. So
Yep.
there's very complicated challenges, and we want to make sure that no one is left behind or put out of business because of this energy transition.
Right. So that leads very naturally to my next question for you, which is what would be your counsel to policymakers or regulators about ways for them to think about this?
Yeah, I've always really thought that, pricing the attributes that we really want or need in the market is probably a good way of making sure we're getting what we need.
Hmm.
We need to be very careful about incentives and mandates and, other, what they call FERC candy. If you hear
Right.
or Christie talk about FERC candy or any other sort of incentive,
Right.
we want to make sure that, those don't impact the market too much and that we are looking at competition and finding the best solutions. And part of that is understanding what is it that we want. Do we want X amount of clean? We want
Hmm.
X amount of reliability. Let's put a price on those, to help really inform what we need out of the market and then let the competitive forces work in that. So that's a huge one. And I would be remiss if I didn't put in a plug for the one policy thing I've been beating the drum on is an independent transmission monitor, which is, I realize, not a popular concept, especially with the utilities. And,
Sure.
I've been trying to help, the FERC and other policy players understand, exactly what we want out of an independent transmission monitor. And it's a way to sort of bridge that knowledge gap and that data gap with, the consumers that are paying for this with, the planners. There's a
Hmm.
big gap there, and we really need a sort of independent authority engineer type that can say, yeah, what we're planning is good. They've taken this into consideration and this consideration, and this is the reasoning behind their decisions. And so it's not a position to second guess anybody's decisions,
Right.
but more of an information and helping clear up that black box that consumers sometimes run into with stakeholder processes, either in an RTO or outside of an RTO.
Yeah.
So
I
I
think that's,
will keep
yeah,
that.
I think that's fair. It does happen in both environments, and I think sometimes that gets lost.
Yes.
So, as a last question, what's your key message about how to solve the load growth problem, and how do we continue to support the growth of the manufacturing sector as a whole while we do that?
Yeah, absolutely. I think that unfortunately, and within probably the last decade, maybe even less, we've seen just such a politicization of energy. And I think that there's a lot of misunderstanding about energy and making it a very partisan issue when
Hmm.
it's a good that everybody needs. And so as industry, it's very important for Elcon to be out there saying, look, we can't look at it through, a specific political lens. This is a great need. And we, as manufacturers who are growing, we are bringing jobs, we're bringing, support for state economies.
Hmm.
And we are going to be looking at those state and regions that are open to all of the above, which is, what Elcon's philosophy is, at least right now. We need all of the above solutions. And so if any of those solutions are immediately taken off the table, that's just not going to be attractive to industry to try to do business in those areas, whether it's a specific form of generation or a refusal to look at transmission because it's
Mhm.
just assumed that it's to help some other states, policy. There needs to be a better education and a better understanding that this is a good for everyone, and we need not take anything off the table right now. And so that's really the message I've been trying to give to regulators, that this should not be a political issue. This is a common need of US citizens, and we need to make sure we're doing this properly.
Next, we'll look at this issue from a different perspective. What are investors in the energy sector thinking right now? Anthony Crowdell, a managing director at Mizuho, says load growth can bring more opportunities to the sector. He shares how utility investors are looking at utilities and independent power producers to meet the moment when there is a growing demand for more power. And he also shows us the flip side of that coin, outlining what key drivers are pushing the load growth, as well as what it's revealing about issues impacting the market. Here's Anthony. Anthony, thanks for joining us today. We've got a couple of things, so I don't want to treat it as rapid fire, but keep this in mind when I ask the question. So what are you looking at, or what are you thinking about from the analyst perspective when you look at the following things? Load growth, how much, how fast, how much of this is real, how much might be a little bit overblown? Is it going to be as big as some are projecting? What factors could temper expectations? We think we know what's driving it, but what are you looking at from a Wall Street perspective for investors about what's driving the growth? And then what are the resources that you are watching for investments? Is it renewables or gas, nuclear, storage, the like? And then what are some of the things that you're looking at as potential roadblocks or opportunities for those investments? So that's a lot, but if you could unpack that.
You bet. So I guess the first thing is we just started super high up, and we're so excited we finally have load growth, right? If I think of my almost 20 years covering the space, we had some load growth, maybe 2005 to 2007, 2008. Recession kind of put brakes on that. Maybe we had a quick little burst in 2010 to 2011, but it's been flat ever since. And so we haven't had load growth, and you can imagine for a utility investor owning a utility that has load growth, that helps offset some of the costs associated with running a business. And so we like load growth. We love companies that had load growth, but if I probably thought hard, maybe we had 2 or 3 utilities across the country that was experiencing sustained load growth. So obviously we looked for load growth probably in all the wrong places. If you went back to 2005, 2006, 2007, we had El Paso Electric that maybe had some load growth related to a base realignment, the BRAC that they went through in Fort Bliss and this great thing, but we saw some efficiencies offset that. Then we were super excited when states started legalizing cannabis. And we thought we'd see some states that would have this load growth through to the cannabis farms and everything else. And that never really came to fruition. Then we were very excited with Bitcoin, data mining, and states like that. And that never really happened. So now we have this data center phenomena that's come through, and we're, super excited because we actually feel like we have strong counterparties on the other side, meaning I think Microsoft, what they want to invest, what Google wants to invest, what Facebook wants to invest. This is not Todd's Bud Shop building a cannabis farm. This is Microsoft deploying real capital. So we're really excited about that. So that's on the plus side. On the minus side, though, I think we may be over exuberant, and we see some numbers out there of 8% load growth, 7% load growth. That may be a little over our skis. I hope, and I think it's probably best for the sector, and we'll probably talk more about the investing and the cadence of investing. It wouldn't surprise me if it was somewhere between 1% and 2% on a longer term basis. If it came so quickly, that big of inflection, I mean, you're clearly going to have growing pains. We may have growing pains just at 1 or 2%, but growing, 8% over a 5-year period is going to be challenging. I think there's some double counting. We see it. If we just pick on Microsoft, let's say Microsoft says they're going to build a large data center on the East Coast, and I see 5 utilities raise their hand and say Microsoft's coming to our jurisdiction. So if it's a gigawatt data center, now there's 5 gigawatts in the load forecast, and we're starting to see that trickle into some of the rate cases with interveners saying that. So I think there may be some double counting. So what could temper it? I think when it comes to actually putting shovel in the ground, deploying capital, I think that's when we're going to start to see some maybe load forecasts get a little more refined. And I think everyone's going to welcome that. The utilities, the investors, we're all going to welcome a little more refined. And that's going to, I think, give a better indicator of the investment rate base that's required to meet this data center load. You jumped in also when you said, well, where does this come from? This comes from renewables, this comes from gas. It's probably going to come from all of it, but I think it's going to matter where you're located, meaning I don't think New York State's going to allow anything other than renewables. Yep. I don't think the Pacific Northwest is going to allow anything but renewables. I think we're going to look back 5 years from now and realize why New York State, maybe the Northeast, or like the Pacific Northwest actually missed out on a lot of this opportunity, this economic development, because of that reason. Mm-hmm. Even with the renewables and everything else, you more than anyone know, you do need those auxiliary services that dispatchable generation provides, such as, frequency control, VAR control. You need that with a large gas plant. Nobody's looking to build new nuclear. Nobody's going to build new coal. I think besides renewables, it's going to be gas, but it's going to be gas in certain locations of the country. But they're also probably going to be the ones that grow the most.
Yeah, I think that's a pretty good assessment. And I like the way you've tried to capture some of that. So as you're looking at it from the investor's perspective, what are some of the greatest challenges you think utilities are facing in terms of the load growth and making the investments that are needed? And maybe that's our sector as well as the utilities. So I don't want you to necessarily just select one or the other, but how do we get past things like what is a risky investment? What are the safe investments going to be? You've already mentioned kind of a regional approach, but how do you think about that when you look at assessing an organization for, we're going to rate them as a buy, or we're going to rate them as a good organization for where we're headed? How are you thinking about some of that?
Sure. I think what this load growth and this investment that's going to be required, I think it's put a bright light on maybe poor rate design.
Okay.
I mean, I think in your previous job, I think there was a part of Northern Ohio that had like some carve out on electric heat or something like that. And they had some maybe subsidized rates, and it made sense at the time. They gave that incentive to maybe get off of fossil fuel and go more towards electric, but they had a design that they probably weren't paying for. And I think we're going to see that replicated across the country in certain areas. So what I'm very concerned with, I think what the utilities that I like, that rate design issue has been solved. I don't think this is going to go into a normal industrial rate if it's a data center boom, given it doesn't create that economic development that a Ford assembly plant would create in a certain jurisdiction, all those jobs. I mean, this is construction jobs, online, steady load, and maybe 4 people on the night shift keeping the air conditioning motors running.
Right.
So I think this is going to be a carve out versus the residential, commercial, and industrial stuff that you and I probably talk about a whole bunch.
So like a whole new rate class, you think, just for data centers?
I think that's where it's going to have to happen, because I think to get the utilities to spend the money, they're very concerned about the residential and the small commercials bill. They clearly want the load, but they know that they don't want to hurt that residential, very politically sensitive customer. And I think they're going to have to carve out a special class for the data center load. And I think the data center load, I think Microsoft and Google and all these large tech companies, they want to be good corporate citizens. And I think they'd welcome that if they could get the hookup to the grid, sustained generation. I think they're going to be very okay with that.
Do you view that differently for an IPP versus an integrated utility? Is the rate design the same implication, or is it a different set of issues to address?
I think it's going to be a different set of issues for the IPPs. If I think of the IPPs, they're clearly going to, work on getting contracts with these data centers, and if they sell long-term PPAs, that's going to be fine. But I think the bigger challenge that's going to be is if we have this continued demand load, we're in a new era of load growth.
Right.
That next dollar of investment for generation in an unregulated power market, that is going to be very challenging to see what happens. Meaning, it's very simple for me to say a data center going in the southeastern part of the United States goes into an area that's not an RTO, and the utility decides to build a power plant, and they get a rate of return on that equity portion of the power plant for 30 years, and it makes sense for everybody to do that. But if it's New York City and we have this load pickup, who's going to finance that new gas plant? Given we've seen power prices just go up and down and sideways over the last 10, 15 years, I think that dollar investment is going to be really interesting to see. At what point do you see IPPs deploying new capital?
Right. Well, spoiler alert, I think you're going to see us deploying capital sooner rather than later, but we'll come back to that. How are you viewing, regardless of the type of model, utility or IPP, how are they positioning themselves to meet the demand, but also achieving their sustainability goals that I know your investors are paying attention to as well. How are they addressing that tension?
I think the sustainability goes from the perspective of the utility. I mean, you see them adding a lot of renewables. I mean, renewables, I think we just heard a stat of how much in the PJM queue, how much is solar, how much is wind. I mean, and how little of it is gas. When you look at all the utilities IRPs, I think of other than maybe Southern Company and Duke, which have announced the natural gas-fired power plant in there, most of them are very heavy renewables, battery storage, and everything else. So I think they're still going to meet it. But it wouldn't surprise me, though, if 5 years from now you and I are talking and you start to see some states take their foot off the gas pedal of those renewable standards, given the grid may have been saturated with as much renewables as they can. And we are now going to go to an era of investment in dispatchable generation. I think if you think of this last build out of renewables or last 10 years, it's kind of been on the backs of that fossil investment, that nuclear investment that was there for 20, 30 years already. And it was easy to come in and put a 250 megawatt solar farm somewhere because you had this great support of VAR control and everything else from gas and coal. Now that stuff is retiring and you have more and more renewables coming in. I think in a couple of years, you and I are going to get to a period of time where even the regulators and the RTO is going to want more dispatchable fossil generation.
Yeah. We talked about AI and data centers and all those things on kind of one end of the load growth issue, but electrification is kind of one of the other pieces, whether it's residential or buildings or industry, what have you. How do you think those can successfully occur at the same time? And I'm really kind of looking at both the consumer impacts, whether it's pick your rate class, commercial, industrial, or residential, and there's going to be costs that are implicated. How do you look at that from an investor perspective? I mean, it's going to drive some of the decisions that the companies you cover make, but on the other end of that, there's got to be somebody that's willing to pay for it. It feels like there's a lot of factors all kind of coming to the same spot at the same time that is going to drive both investment, but also cost implications. From an investor's perspective, how do you manage or how do you look at that when you look at the stocks or the companies that you're following?
So obviously, all that's coming together, building electrification, the data center stuff. One thing I would say, it appears that if we think of the states that are probably, most sensitive to the data center or data centers are really flocking there, it's probably the opposite of the states you're seeing the electrification.
Okay.
If we just thought of probably the urban areas, if we think of California, probably there's more Teslas sold out there than the rest of the country. I don't think there's as many data centers located there as you're seeing maybe in the Northern Virginia area, the southeastern part of the U.S. So we have a little gap there. But for investors, we want rate-based growth, right? We want rate-based growth. Rate-based growth drives earnings, and the electrification push is what we love to see. And that's also going to add, as we said earlier, this great load story that we're finally seeing. But I think the question we all have and the things we're going to be very worried about is rate design and cost, right? Yeah. So we talked earlier about rate design, but the bill impact, I mean, it's just when you, as much as I could tell you that, hey, when I look at my utility bill, it's still less than my cable internet bill that I'm paying. Well, that's fine and good, but for customers that are on the margin, that doesn't help. Right. And if you think of some of the urban areas, I think when, a third of some of the customers for some of the California utilities are on rate stabilization or some type of social program to help with the cost. California may already be there with this issue where they're looking to have rates based on income, right? A staggered class of rates. And so they seem like they're looking at, wow, how do we finance this? Or how do customers pay for this when it's electrification and potentially data centers all coming into one? It's going to be the hardest point for maybe 10 years if you think about, because I think what some of the California utilities are trying to say, your low energy costs, if you mix in the fuel component of your bill, gasoline in your car, it's transition that. But it's still going to be a tough period for customers on the margin. So for investors, we like the rate-based growth. We like that story, but we're also very focused on the percent or the dollar increase that utilities are asking for the regulated, because we know at some point the bills just could get up so high, and politically that's a very bad situation.
Yeah. What differences are you seeing in regulated versus restructured markets in terms of making the investments as well as ensuring reliability and cost implications as electrification continues? I mean, there's different parts of the country that are structured differently, as we've already kind of talked about. How are you viewing that from an investor perspective? Because IPPs all of a sudden are starting to get attention where for a number of years they were kind of out of favor, and now it seems that there's maybe some attention back on that sector. How are you thinking about that?
Yeah, no, it's exactly right. Like the IGPs are finally getting the attention, right? Just even look at nuclear. We ignored nuclear plants in this country for 30 years, and we didn't care about carbon-free dispatchable generation, and we ended up closing so many nuclear plants that if you thought of the market that's today, how valuable these plants are, not just economic, but also for the grid. It's nice that the IPPs are finally getting that support, especially the stock prices. You're starting to see that. The easy one is the regulated stories, those markets where the generation is just in rate base, earned a fixed return off, and that's just adding to the utilities that we like that are growing at a healthy clip, and you're seeing attractive rate base numbers, and maybe the cost is more manageable. So that's the easy one. I think you're going to continue to see that, and they're guaranteed a return, and that's easier. The harder question of the IPPs, and if you think of just like, let's just pick on one of the bigger markets, ERCOT, there, I mean, it's probably a harder decision going on there, meaning we think power price will continue to rise there. Not surprising given all the demand that's going on, the growth of the state and everything else. But, you know, the IPPs to start deploying capital, I think it's going to happen. They're going to deploy, they're going to build. But I think they're going to be more guarded than they were in the last cycle of 2000 to 2005 that maybe we overbuilt. I think they're going to be guarded here, but I think the regulators also realize even though they don't have, you know, the PUCT doesn't regulate generation in Texas, it wouldn't surprise me if you start to see legislators or the government started getting involved to help out IPPs expanding the generation in states. And I don't think they're going to be as aggressive as they were in the last cycle, but they will build, but I think they'll be much cautious, but I think they'll get much more support from government.
Interesting. How are you looking at some of the things that we're already facing this summer with heat domes and kind of ongoing seasonal strains on the grid? How's that impacting investment, or how's that affecting your thesis as you look at the companies that you cover?
It's been a huge deal. So if you just put up a map of the United States, and if you snapped a chalk line somewhere where Oklahoma City was the midpoint, and let's just put Oklahoma City on the east side of that line and the rest on the western side. With the exception of maybe two stocks, roughly about 40 stocks in the sector, there's no utility that trades at a premium valuation that's west of that chalk line. That is also the area that's very heavy, or just has a higher wildfire risk than the East Coast. If you just think of the Texas wildfire we had earlier this year, Colorado fire a couple of years back, the California, Maui fire, it's clearly impacted investor decisions. And we're all looking for either a state or a federal solution to help put a cap on liabilities. Until that happens, I notice, even though I like a story, I like a stock that maybe has great regulation, great rate base growth, for someone putting capital to work out there, you're seeing a pause. And I think what really got this going, if you remember the February letter by Warren Buffett, the shareholder letter he published, he highlighted, I mean, Pacific Corp, what the utility that he owns, I mean, Oregon, the liabilities have just kept running up and running up and running up. They get to a sympathetic court on non-economic damages. And he said he's actually lost so much money that he would think twice about buying a utility. We see some changes. Utah's come out. So that's the wildfires. That's a big deal. Now we get to even something more present day is the extreme weather that's faced Houston and what they've gone through in the Houston market. It seems that that's happening more and more. And the valuations of these utilities are coming down. I mean, I guess take a step back. If you think of the average utility investor, they may be the most risk-averse investor you've seen. And the ability for them to digest or handle the uncertainty with a wildfire, the uncertainty with storms, is also probably leading to more East Coast or east side of that chalk line, less hurricane risk, less wildfire risk. And I think that the end of this, what does this all do? I think you talked earlier about those two things colliding, which is electrification and maybe the data center thematic. Yeah. I think the third one is actually there's three things colliding, whether it's climate change or extreme climate events. I think you're going to see even more investment to make the grid more robust, because we all know, you know, all of us, myself included, my house has become more and more digital, my thermostats, my cell phones, Wi-Fi. The ability for my family to take an outage that as a kid in 1977, the lights went out and we ran outside and we played wiffle ball for all night, thought it was great. If I had the same outage today, I think my kids would go nuts. And so I think that's going to spur more investment in the grid to handle these extreme weather events.
So to sum it all up, what do you think is needed from either a regulatory perspective or from a markets perspective to drive the right amount of investment? I mean, what are you looking from the investor perspective? What are the things that you say, these 1, 2, 3, you pick your number. This is what we want to see because that's how we're going to make sure we're making good decisions on the investment front.
I guess number one is rate design, / affordability, that the state has that figured out. And I know that in that state, when the data center goes there, the residential customer who's very political, their bill is going to be, manageable.
Yeah.
The second thing is I'm looking for the states where there is enough power. You have IPPs, you have dispatchable generation. That the data center going there, especially if there's growth of that data center, that there's enough generation to meet that. Yeah. So that's probably the second thing. In a state where you have attractive reserve margins and also states where you could add and continue to grow and add to that should load continue as we thought. So one, rate design. Two is I want to be in an attractive market where you could have load. And three, I think we want to see the counterparty that is building that data center, that start putting money down. Obviously, if you hear of a large, big tech, Microsoft, or Meta, or them, they're doing it, you feel much more, you feel much better about that. But we want to start seeing that. And so all three of those together, I think when you look at the stocks that have worked so far, and I think the stocks that have continued to work, they have a piece of all three of those in it, and that's what's working. The flip side, if you think of the stocks that have struggled the most, it's been one, or if not all three of those pieces are missing, and they've been the laggards so far this year.
On the next episode, we'll take a closer look at how rising demand will impact the power system. You'll hear from Jim Robb, President and CEO of the North American Electric Reliability Corporation, Christy Tezak, Senior Director at Clearview Energy Partners, and Aftab Khan, Executive Vice President of Operations, Planning, and Security at PJM Interconnection. We hope you enjoyed this first episode of Energy Rush. If you like this podcast series, we invite you to check out Energy Solutions, EPSA's regular monthly podcast featuring the voices and stories from a changing energy grid. You can find all episodes on our website or your favorite major podcast platform. Subscribe, follow, leave a rating, and comment on Spotify, Apple Podcast, YouTube, or Pandora. And follow us on X at EPSA News, on Threads at Electric Power Supply, and LinkedIn for more news and updates from America's competitive power suppliers. The music in this episode was written and produced by Let Me Hold That Ltd.
Energy Solutions is brought to you by the Electric Power Supply Association. EPSA represents America's competitive power suppliers, which bring about 150,000 megawatts of power generation resources to customers throughout the United States. Discover the power of competition at www.epsa.org.